Welcome to another episode of the Wealth Building Strategies Podcast. I'm your host, Jeremy Constantino. And today I'm honored to have as a guest the legend himself, Sam Silverman. Welcome, Sam.
Yeah, thanks for having me on.
Yeah, it was nice seeing you a couple weekends ago in Louisville.
Yeah, yeah, no, it's definitely one of the better conferences I've been to.
Yeah, and at that conference, for those that you do not know, Sam, you got some recognition there at the conference as well as a speaker too. I think you were talking about short term rent, or no, you were talking about fund to funds
Yeah, so
at the
kind of a, a
conference.
new a new concept too. So if you want to dive into that later as well, it's in my opinion, the most legal way to raise capital and scalable when you kind of look at how you go out, growing your business within the SEC guidelines.
Excellent. So a little bit about Sam for our listeners. Sam is the founder of Silverman Capital, and he has raised around $50 million in capital. So congratulations, Sam. And last year you had a killer year, raising $40 million in capital. And so congratulations to your success. And it was great to see you at Raise Masters there receiving your award for I think you got a trophy for the reaching that $25 million mark, which I don't think they have a trophy bigger for 40 or 50, do they? Or do they have a 50 million?
I don't think so. I'm sure they'll adjust though for next year because I think there were a handful of people who were kind of in that bracket.
Excellent. Well, congratulations, Sam. Very impressive. So let's dive into this podcast. And I guess, first of all, let's get to know Sam and talk about your background and how you got into real estate.
So like most people, it was entirely accidental. Played baseball all my life growing up, was into I was an entrepreneur, right? So I built and sold a company in high school in 10th grade.
Oh,
It
wow.
was an event planning company, right? So that was my first foray into kind of my own business, running a sales team. So we'd rent out this giant event space in New York where they had Fashion Week every year in Lower Manhattan. And we'd, get a DJ, make it a big teen night party, and I'd have a kid in every school selling tickets. And they were pure commission sales reps, right? So that's my first avenue into my own business and into sales. I think sales is the best business to go into for anyone, right? If you're kind of in the crossroads, like what do I go do? Figure out how to go sell things, right? Like that's a skill that will take you very, very far, and it's insanely transferable depending where you want to go. So kind of built that business, really profitable for years. So actually sold it as well when I was 15. Went to college, played baseball for a bit, realized that was just not going to be a place in which there was going to be a career where, you're making a livable wage. Baseball's a really tough sport to go make it where you actually get paid in. So, got into sales, started in tech sales, can move my way really quickly on the sales side. And then you realize, okay, I've got a pile of extra cash because my living expenses really haven't gone up too much, but your income, especially when you're first starting out, can double the first 3, 4, 5 years you're working, right? And that's what happened to me, right? So it had surplus of cash. I'm like, okay, I understand passive income, right? Things that pay you for either your money or the sweat equity you put into them over time. And I realized that over time, I fall much more in the former than the latter, right? Where I want to trade my money for more money versus my time for more money. And with me, what I realized is that all that time I spent building a single family portfolio, I think I got to 10 houses. And it was just not what I wanted to do, right? Like the kind of the big flip moment for me, I had a tenant drunkenly drive over with a lawnmower their sewer line, right? So I'm, in the middle of and finishing a quarter for work, with 6 figures plus commission on the line and that end of the quarter. And I'm getting calls about a sewer line from a tenant that did that, right? So like just kind of thinking about what do I want to be doing in my time, right? And like what's worth it and just what's worth my headspace and mental capacity and like putting my top energy onto things like that. Just realized it was not for me. So I made the shift to investing passively, right? Where I was writing checks for, 25, 50, 100 grand into different projects, right? That you are, owning a fraction of that either that portfolio of assets, that single asset, whereas kind of a better class of assets because you're getting into a larger pool of people, right? Kind of pulling their capital for fractional ownership. So I think I did about 18 of those deals at first, and then realized that people keep asking you, hey, what are you doing? I'm like, what are you working on? I'm like, okay, let me go see if there's actually a path of me actually being one of the sponsors on these projects. Because I found there's two things that matter, right? You find a deal or you find money, right? And I felt much more in the latter camp there. right? Kind of taking those sales skills, taking the prospecting skills that I've built in the sales world to go kind of leverage that for these types of projects. So here we are now, a year and a half or so later. We've done 30 plus deals. Now the big focus in the short-term rental space right now as well. Yeah, definitely, the right transition, and went actually left my corporate job, I don't know, 4 or 5 months ago to go full time here. So made the big leap, and definitely glad I did it.
Awesome. Congratulations. And so just like you, I also played baseball in college. I played at the University of Oklahoma. What position did you play?
I was the unathletic lefty pitcher. Um, yeah,
Lefty pitcher. How about that?
yeah.
So where was your market where you had your long-term rental, your single family rental properties?
So actually in St. Augustine, Florida, so
Okay.
like a submarket of Jacksonville, kind of
Okay.
in that vicinity. And when I bought there, the first house, it was legitimately farmland, right? So the first house in the block, I think I owned 10 of them within, a mile radius, where it was now 50, 100 houses, right? So very up and coming area. Um, Actually found the first house in Roofstock, right? And then from there, from the seller, right, from the closing documents, called him. He had 9 more he needed to get out of because he had back construction debt. Bought them one by one in cash in terms of delayed financing, right? Because they were appraising in that $200,000 range. I was paying 140 to 160. They ended up owning 10 houses for like 50 grand in cash after a year.
Wow. Wow.
And eventually sold those houses to Zillow, right? When they were still buying homes. So just because it was kind of a lower income area, most people were buying homes were either on VA loans or FHA loans, right? So you don't have a lot of wiggle room in terms of any kind of issues when you look at financing, right? So in a FHA loan, you're putting 3.5% down, right? So if there's any kind of appraisal gap, then they have to cover that, and they can't afford to cover that, right? They're typically people who are using those loans for the most part are having, they're scripting those down payments just to go qualify, right? So if there's any gaps there, that's going to add to your pocket. So they removed all the risk for it. They had, low selling fees. They were kind of in that price range I wanted. So it was a really easy process to move quickly. And then kind of convert all my focus just into the passive investing world. I think I'm in 50 LP deals at this point or so, give or take.
Fantastic. All right, let's talk about kind of how we just kind of stepped in at the beginning of the conversation, fund to fund model. And so, Sam, a lot of our listeners are real estate agents, real estate brokers. That's what my sphere is. Part of JPAR Real Estate Network, about 350 agents in our offices. And so we have a lot of agents listening to this, and they want to start getting involved in capital raising. They want to start getting involved in passive investing. And let's talk about this concept of fund and fund and how our agents can start getting involved.
Yeah, so when you kind of look at the fund to fund structure, what you typically see is that a project will have different economics of shares, right? Say one should maybe for someone investing 50 grand, one should be for someone investing $1 million, right? In that $1 million class of share, there's ideally enough of a spread between that $1 million class of share and the share of $50,000 where someone can come in and pool capital together, give their investors either equal or better returns than going direct to the sponsor, but still have enough of a margin there where it's worth their time to help pooling these people together, right? So you can create something called a SPV, a special purpose vehicle, that are essentially legal documents that allow you to go structured entity to go pool people together, go buy into that larger class of share from aggregating capital for kind of like I was investing in people who have fractional ownership of that SPV. And then you're investing with a sponsor and getting better terms, right? So, investing through an SPV or investing as the kind of sponsor of it, there's different avenues that you can go. And all of them are dictated by how the sponsor sets up the project to make sure that those economic class of shares are worthwhile for both the investors and the sponsors in them.
Excellent. Great explanation. And so, full disclosure to the listeners on this podcast, that's exactly the relationship that Sam and I have right now. Is Sam is doing a project right now for Techvestor's a short-term rental project, and he reached out to his network and he said, "Hey, does anybody want to help raise capital and be a fund manager?" And so I raised my hand. I know Sam, and I said I'd love to do this, raise capital for this project. And so just here recently, we created the legal documents, and now I'm a fund manager in Sam's larger project.
The nice thing too is that kind of the economics that how we structure the project is that we encourage everyone to go through Jeremy, right? Where they actually get better returns going through Jeremy than through us, but there's still enough there where it's, worth his time and effort to go do it as well, right? So I think it's a really unique structure. I think also a big piece of it too is that's entirely compliant when looking at the SEC regulations, right? We plan to do this for a very, very long time and you do that in a few ways, right? One is compliance, right? Two is doing what you're saying you're doing in terms of investor experience returns, and just being, operating in all ethical ways, right? So that's how we view it and kind of those three pillars of how you operate a business.
Excellent. All right, so let's talk about this project, and well, actually, let's talk about last year short-term rental project. I heard about it towards the end of 2022, and I was immediately impressed with this opportunity. And it took about 2 seconds for me hearing what the project was about for me already sending the wire in and signing the documents. That's how exciting of a project this is. So go ahead, Sam, and talk about what went down last year.
Yes, that was our kind of first full fund as a group. We've all done different projects in the past, right? So a bunch of us owned, handfuls of Airbnbs previously. I mean, I've been involved in 50 or so transactions in multifamily, self-storage, mobile home parks, debt. So a wide variety of areas. And to me, this is a really unique space because we're early, right? Multifamily is probably in the 10th or 11th inning right now, depending how you look at it. So I like things that still have some buffer room, right? Still have some room for compression. Compression meaning that the valuations can still go higher based on cap rates, right? So what I think we're seeing is that when you look at institutional capital coming into a space, you see valuations go up, right? Because they can write larger checks, right? And things like that. So this space, to me, I think there's a big moat here for people who have a really strong operational company to go support the actual property, right? Because if you look at an institution and they want to go buy a $100 million multifamily asset, they can write a check now for probably $40 to $50 million to go take the project down in one check, one easy swoop, right? Whereas if you look at this space, you're buying typically individual homes, you're going in, you're branding them, designing them, furnishing them, staging them, right? All those things. It's just a lot more of an operational lift. And the management's much more heavy, right? In terms of people saying for 1, 3, 5, 7, 25 days, right? Versus someone who's signing a 12-month lease. So what we believe is that there's still a single family homes are a mispriced asset because they're trading based on comparison value, but we believe they're going to trade based on net operating income similar to commercial properties, which we've already seen so far in Fund One. We've sold off 8 properties so far between a 5.5 and a 6.5 cap rate, right? Which is really strong, and that's off single assets, right? What I see in this space is that this is a consolidation play, but the more assets you have, where a large group can come in and buy the collective portfolio, you'll see a more and more compressed cap rate for yield. Right, these are also really strong cash flowing assets that have the ability of changing pricing day to day versus being locked into a substantial lease. So we feel as though this space is really well positioned, and also just that the money you spend on design will go a very, very, very long way. Right, when looking at the experience that your guests have, right? So everything we do is focused on experience, investor experience, guest experience, or all those things tied together for your business. It's kind of a two piece play.
Yeah, so let's talk a little bit about the numbers from last year. So last year, Techvestors, you guys, or I'm part owner in that as well. We bought, I think, 80 or 81 properties throughout the year. You had 8 exits, and I guess talk about the performance compared to the market out there.
Yeah, so I think a big thing is just kind of like tying back those exits, right? We exited those properties for 2 reasons, right? One, proving that our thesis that we can buy properties based on value, right? Comparison value, like you all sell homes on, right? And sell them based on a cap rate,
Right.
right? So that was the first piece of it. Also, earlier in the portfolio as well, it helped boost cash flow to investors, right? Because there's a ramp period, right? Because you're taking capital, you're buying homes, getting them live, and they're producing. So we were able to kind of help boost cash flow earlier on for investors. But I think a really big thing when you look at it is, how are we pacing versus, like the market, how are we pacing versus market? To me, doesn't really matter. It's more so how we're pacing versus our projections to our investors, right? When you look at how we model things for Q4, I think we modeled $650,000 of revenue. We mentioned 841,000, right? Which just shows that, we're pacing in 25-30% above pro forma and looking at revenue as well, right? So we believe we have a lot of upside there left in terms of making a few key hires, right? So, kind of hiring ahead of time for people who can help us go scale and drive, profitability across the portfolio.
Going back to what you were saying about your early experience in single family rentals is the important thing to contemplate is how intensive it is on property management and oversight from the owner. So if you're an active investor buying a property and renting it out, even if you have a property management company, it takes a lot of effort. And
It's not passive.
exactly right, it's not passive at all. And now as you get into hospitality asset class, which short-term rentals is, it's hospitality. You're basically running a hotel, but spread across 10 different markets and 80 different properties. So to get into, for an active investor like ourselves, to have a portfolio of multiple single family homes rented out as short-term rentals is practically impossible unless you have a fully integrated team there to do all that work.
Yeah, it really is. Like you look on the acquisition side, and we saw acquisitions get really easy for a period of time the last month. Now they're with the rates dropping back down a bit. We're seeing them, the market's heating back up, right? So when you look at it as one, acquisitions, right? That's a
Yeah.
huge crux for people in terms of scale, is that they're individual transactions. Now our average purchase price was under $600,000 last year. So think about to go and deploy $100 million plus, a lot of transactions to go do, right? So we built our own tech that actually allows us to go take all of the data from Realtor.com, the MLS, run it through a custom underwriting tool, kind of what Zillow did with the iHomebuyer program, but we go a level past where they do, right? We just use to help weed out properties that are below our cash on cash criteria. And we have a full acquisitions data science team that actually goes hand on writes those properties, leveraging the keywords, right? Leveraging kind of the amenities, the structure of those houses, et cetera, to see which ones make sense to make offers on, right? So we're leveraging technology to make us much more efficient versus solely relying on technology to make our decisions for us, right? So we view it as a human aid versus a kind of tell all be all, right? And to that side of it, we have a full team that is just in charge of how do we optimize revenue within the portfolio between pricing, between amenities, or all those things which we actually close. We have a head of construction that solely works on negotiating contracts for us in terms of does this make sense from a cost basis? How can we push vendor relationships down? We also now scale in certain markets as well, right? Especially the big thing for us that portfolio two can benefit from portfolio one, three to two, et cetera, right? Because each year we're building a whole new portfolio. So those economies of scale for vendor relationships drive down costs substantially. Right? All
Absolutely.
those costs that you drive down are directly to your bottom line NOI, right? So which is a huge thing. So for us, for example, I think we just negotiated, 100K off a contract we have in Scottsdale because we have a lot of properties there. That 100K is worth, $1.25 million at an 8 cap, right, in valuation just from negotiating a contract, right? So things like that give you a lot of leverage, and also the fully built out property management team gives us control too, right? We have design in house, we have property management in house, all those things allow you to control the entire experience from end to end for your guests, and therefore have more control of the success for your investors.
Yeah, the concept of having a diversified portfolio across multiple markets in the United States is a phenomenal concept, and there's very few investment opportunities that have a diversified portfolio. Usually, you can see a portfolio in a given city or a given sub-market where they have 5 or 6, maybe 15 rental properties, but that's all confined into one sub-market. What I love about this project, it's diversified across the United States.
Yeah, and that's a big thing too, is that, if you're investing into, say, a multifamily deal, it's typically one asset, maybe two assets that are kind of close to each other. Or here, if we buy 250 houses this year, we're in 10 markets today, maybe 15, 18 markets by the end of the year, right? If not more. So you're not only diversified across, destination markets, urban markets, you're also diversified in terms of markets that are seasonality wise, right? Some markets may perform better in the winter, right? Like a Scottsdale. Some markets may perform better in the summer, like a Poconos, right? So you have the optionality of kind of where you are that gives you a nice blended yield throughout the year as well. Your money is evenly spread across all properties in the portfolio pro rata, right? So it gives you a nice, probably in the smallest checks, the most amount of properties you can be into.
So how would you answer a question from an objection saying that hospitality may slow down and there may be a risk of another pandemic or something that causes hospitality to slow down? How would you answer some of the objections? Because when I look at this project and what you guys did last year, that's the only risk that I can see that has happened before, that maybe a little bit of slowdown in the hospitality. But
Have you
I
guys
mean,
looked at the numbers from
yeah,
Airbnb from the COVID time? That's probably one of the best times to be an Airbnb possible when looking at the data around it.
really,
Um, yeah, so all of it
wow,
spiked up in that period of time in terms of performance. Um,
wow,
so right for us, like also look at it too. If you look at a slowdown, so say for example, there's 10 houses, right, and there's 10 people booking houses. All those houses will get booked, likely in order of either affordability or in terms of the design, experience, etc. If there's only seven people booking houses, the top seven houses are still gonna get booked, right? We're always in the house one or two when looking at how we structure and how we design properties. So in terms of guest experience, amenities, right? All the little detail that we put into them still allows us to perform extremely well in the market. And I'll give you an example. So I believe for Q4, we price in the 91st percentile across the board in our portfolio. We still had occupancy of almost 77%, 76.5%, right? Which is well above market and actually well above how most people price. So for us, we believe we have a lot of insulation there. But I think a really important thing to think about this too is that our debt service coverage ratio, right? Basically, which means, what's your net income versus your debt that you have, right? It was, mostly you look for, hey, is it 1.25 good,
right,
1.3 good? We were
right,
2.5.
wow,
So we have to have a lot of things go really, really poorly
yeah,
for that to go drop down below there. And we still believe about 15% more revenue we can go push out in our existing properties today, which actually boosts that ratio even more, right? Which
wow,
is why we brought on people to kind of run the portfolio internally, where their sole job is how do we boost revenue in the properties we have live today. So, um, we're a handful of hours, most major metros in a lot of these areas too. So my take, if you see a big recession, right? Still TBD how big it's going to actually be. I think we're in it right now. It's more a matter of how big it ends up being. I think we'll see international travel cut down, but we're still going to see people traveling. People will still leave their house. People will still go places. People will still go drive to different places as well. So we're still really confident in the asset class overall. And we have
excellent,
enough buffer room where stuff can go wrong and we can still survive, right?
right.
All of our debt is fixed rate for a long period of time. So um, yeah, we feel really confident we have things in place that allow us to go right at any kind of downturn period if there is one.
Excellent. Yeah, well, in Louisville, I asked you a question, and I'll ask you again. Last year, when you're having conversations with passive investors regarding this project, what did you gather as their primary reason for investing in the short-term rental fund over multifamily or any other asset class?
So multifamily, I think like I said earlier, I think we're really late in that cycle when you look at how deals are structured. And there's also no yield there right now. Like most people,
Yeah,
if you're buying a deal, you have a few ways to give investors yield, right? Which I don't love. One is a tax havens strategy, which
right,
kind of handcuffs you upon the exit.
right,
Two is you're actually raising cash from investors to go pay them back their own cash. All of our distributions are actually from true cash flow. So we're typically seeing a lot of multifamily yields right now, especially in a more major metro, take a Phoenix, take a, parts of Florida, Dallas, Houston, etc., is that operators are actually going out and raising your extra capital, which dilutes the investment substantially, right? If you raise $10 million versus $8 million, you have to go earn, more on those $2 million to go pay
yep,
the same profits,
yep.
right? So there's still yield left, right? Where we're buying some deals that we're walking into them once they're stabilized at 15, 18 cap rate,
That's
right?
incredible, incredible.
So when you look at, we have probably the biggest spread between our actual cap rate from when we buy it and we stabilize it to what our debt looks like. So for most people, when debt goes up, debt's above most multifamily cap rates right now, which gives you, that kind of improper imbalance, right? So we had the most kind of bandwidth for taking on debt and something to give solid yield. We're still impacted when debt goes up, but much less so than other areas. So kind of how I view this investment, right? Take a multifamily yield, for example. You typically see a class A share, call it 9-10% cash flow that's paid first in priority, but there's no equity tied to it. So there's no depreciation. I mean, that's taxes or income, which means that even if you can't qualify for REP status, you can still use depreciation from your passive losses to offset passive gains, right? So a class B share, for example, multifamily, it's, I don't know, call it a, 7 and 70 or whatever it is in terms of how they structure it, right? What that means is that the first 10% of profits go to you, and you also get some equity in the back end. But those deals, for example, they're cash flowing 3-4% actually in terms of the actuals, right? But you still have the investment there is meant for the equity upside. Right? You have depreciation in those deals. So you have the equity upside that gets you to, I don't know, a 1.8, 1.9, 2x potentially in a target. So what I think why this is really nice investment is that you have the yield overall similar to a Class A, kind of that 9-ish% type yield. But then you also have the depreciation like a Class B share, so that yield can be tax deferred. And you also have the equity upside like a Class B share as well for when the portfolio sells and can have the same level of upside, right? So like I view this as a really nice combination of those two areas that gives you cash flow, gives you some depreciation, and also gives the equity upside upon the exit. And also just, I think a lot of things are in place that aren't going to force us to go sell. We have 10-year fixed rate debt on all the properties, right? So I typically see people get burned in real estate from one, just buying horrible deals, right? Two, their timeline's too short in terms of their debt, right? I think you'll see some distress in multifamily this year from bridge loans that are coming due, in which they can't go refinance the loans because the debt service coverage ratio doesn't cover it because their debt's gone up, that the income hasn't gone up enough to go wash that out. Or they're just not, don't have enough reserves in terms of liquidity, right? We actually upped our reserve recently as well in the last quarter, just to give ourselves more buffer room, kind of a just in case fund. So we feel really confident that kind of in those three areas, we're positioned really well to go right at any kind of downturn and make sure we can have an optimal exit when looking at how we perform for investors. It's also important to note too, is that kind of at the operating team level, we take zero fees, right? So all of our money is directly in line with how you all get paid too. It's past the preferred return, which I think you look at in aligned incentives. It's about as aligned as it gets when looking at how we structure the projects as well.
Excellent. Yeah, over the last year, our commercial real estate brokerage, my business partner and I and our company, we have decided to get into real estate syndications and in capital raising last year. And as we were deciding what real estate asset class to start acquiring, we immediately noticed what you're saying too. The yield in multifamily just isn't there. The compression is there. So the compression is so compressed. And as we start getting into CoStar and start looking at the different multiple real estate asset classes, the availability, there's no supply in multifamily at all on CoStar at all. So you have to get everything off market before it comes on. And then as we look at the other real estate asset classes, retail, industrial, office space, we put an offer on a 5-building office portfolio here in Ohio, and we're under negotiations. But on the market, you can buy things at 9-10 cap, stabilized, like you're saying, 14-15 cap, and it's brilliant, and these other asset classes are being overlooked. And so but we made a decision for our company is we're going to say we want to have a fully diversified portfolio that we can offer investors in addition to multifamily. And that's when I saw you're reaching out for fund managers for this asset class, short-term rental. I was amazed. I said this fits our investment thesis of having a good diversified options for investors.
Yeah, I agree.
Excellent. So any last words to our investors? The majority of our investors, like I said, are real estate agents and brokers that are listening to this podcast. Any last pieces of advice for getting into commercial real estate and getting into starting investing themselves?
I think it kind of ties back to what I was doing when I first started, right? Where I was in a similar role, right? In a sales capacity role, where if you perform well, you can make a lot more money than if you don't perform well, right? If you can go close more deals. So for me, investing passively was just the easiest route to still be able to go focus full time on my day job and still be in the asset class I wanted to go be in, right? So I viewed it as my time is just better spent in my day job and just writing checks passively to get into the same asset class I wanted to be in, but not on be hands-on in terms of that. And if you ever do want to go hands-on in the future, it's basically a highly paid education course along the way as to what do you do, how do you operate, right? Kind of getting insights as what should you do, what should you not do, right? Kind of seeing that whole scope from the operator's view. So for me, kind of going back, I would do it again. I would definitely go into this investing much quicker than I did on the single family side. Yeah.
That's excellent advice. And the trap for real estate professionals, real estate agents, and brokers is that we are more than qualified to be the active investor, to finding the deals, to negotiating the deals, to, you know, selling the deals and managing it. So the trap is that an agent sees a good deal and is like, okay, I can jump in and be an active investor. And then all of a sudden it's this massive time suck. And then you've lost all of your momentum that you had in your sales, in your production. So you're making two, three, $400,000 a year in production and sales. And then now it's a time suck going into active
Yeah.
investing. Excellent. All right. So so we have this awesome deal coming up and we can advertise it. We can talk about it. And I will leave in the show notes for this podcast how you can learn more about the short-term rental fund. I think so. The short-term rental fund, we're going to be buying, 150, maybe 250 homes this year. Is that the plan?
Yeah, so our goal is to raise $100 million to buy between 250 and 300 homes this year.
Okay.
So all dependent on kind of the capital that we bring in. But yeah,
Excellent.
we'll buy as much as we have in terms of capital, right? So we have no issue in terms of deploying capital. We feel really confident about that $200 million mark this year. So yeah.
Excellent. All right. So in the show notes, I'm gonna be putting links for we're gonna actually be doing a live webinar here coming up next week, and so I'll be putting in there the link to our investor portal so you can invest with Sam and I on this amazing project. And for the listeners out there, if you haven't already started investing passively into real estate, commercial real estate, now's the freaking time. Sam, thank you so much for joining this podcast. And until the next time, this is Jeremy Constantino signing off for another episode of Wealth Building Strategies Podcast.